Have you seen this? One of the world's oldest, most reliable assets is being talked about for a huge surge in price. Today, we're going to dig into a really bold forecast from Goldman Sachs that sees a very, very bright future for gold. Let's get right into it.
Okay, let's just put the number right out there. $4,900. That's the price Goldman Sachs is predicting for just 1 ounce of gold by 2026. Now, just to put that in perspective, that's a jump of nearly 20% from where we are today. For a massive global asset like gold, that is a huge move, and it's one we've got to look at a lot closer.
So a number that big, it kind of begs the question, right? What in the world is driving this stunning forecast? A prediction this bold isn't just a random guess. It's got to be rooted in some powerful global trends. So let's break down the mechanics behind this thing.
According to the analysis, this whole forecast really comes down to two main things. You can think of them as two powerful engines, both pushing the price of gold in the exact same direction. Let's unpack what they are.
So, on one side, you have some of the most powerful financial institutions in the world. We're talking central banks, buying up gold like there's no tomorrow. And on the other side, you've got the US Federal Reserve signaling that it's probably going to start cutting interest rates. Now, these are two very different forces, but here's the key. They're both pushing gold's price up.
And this, right here, is why those Fed cuts matter so much for gold. See, gold is what's called a non-yielding asset. Unlike a bond or a stock, it doesn't pay you interest or dividends. It just sits there. So when interest rates on things like bonds are high, holding gold feels like you're missing out. But when those interest rates fall, the whole equation flips. Suddenly, the cost of holding gold drops, and having that physical, safe haven asset becomes way more attractive.
Okay, let's really zoom in on that first engine, the central banks. Because what we're seeing here isn't just them tweaking their portfolios a little bit. No, this is a fundamental shift in how they think about what a safe asset actually is. And it was all triggered by one single global event.
The analysis literally calls it a big wake-up call. And that phrase is perfect, isn't it? It just perfectly captures the shock that went through the entire financial system. You had reserve managers all over the world. These are the people in charge of protecting their country's wealth, and they suddenly saw a new kind of risk they hadn't really considered before. And here's the chain reaction that it started. It all began in 2022 when Russia's central bank's reserves were frozen. That one move sent a shockwave across the globe. It showed every other country that assets held in the traditional financial system could be vulnerable to geopolitics. The reaction? It was immediate. Central banks started scrambling to buy an asset they could physically control. And this isn't just a temporary trend. It's a structural shift that's expected to keep on going. So the crucial takeaway is this. For a central bank, gold is the only truly safe asset for one very simple reason. You can hold it yourself. Once that gold is physically sitting in your own country's vaults, it's safe. It's totally insulated from the risks of the international banking system. It's basically the ultimate form of financial independence. So we've talked about the big institutions, but the analysis points to something else, a potential amplifier. What happens if the rest of the market, private investors, starts to follow the lead of the central banks?
You see, right now, this huge buying trend is actually pretty narrow. It's been driven almost entirely by central banks. Private investors haven't really joined the party yet in a big way. But this sets up a really fascinating what-if scenario. What if they do decide to show up?
Now, to understand the potential impact here, you have to see this comparison. This chart shows the size of the global market for gold ETFs, which is a really common way for regular people to buy gold, right next to the size of the US Treasury market. And the difference is just staggering. The Treasury market is about 70 times bigger.
And here is the punchline. Because the gold market is so much smaller in comparison, it doesn't take much to move the needle. Think about it. A tiny diversification, a small step for investors moving just a tiny fraction of their money out of a huge market like bonds, well, that would be a giant leap for the price of gold. That cash flowing in would have a huge outsized impact.
So when you combine that steady, relentless buying from central banks with the massive potential for private investors to jump in, the bigger picture really comes into focus. It looks like gold has this really unique safety net under it for the long term.
So ultimately, the whole investment idea has two paths. In the base case, the most likely scenario, you have the central banks buying and the Fed cutting rates, and that alone provides a lot of upside. But then there's the uncertainty case. If the markets start getting nervous about government debt, or maybe question the independence of the Fed, gold is seen as an asset that would perform even better.
It's this interesting position where it's set up to do well if things go as planned, and even better if they don't.
And that really leaves us with the final, crucial question. The world's most powerful financial institutions have already cast their vote. They're treating physical gold as the ultimate safe haven. The multi-trillion-dollar question now is, will private investors eventually come to the exact same conclusion?